and increase. Usually they never family. Can expect family like that. Consequence.
shape of you. We push and pull like a magnet. Although my heart is falling too. Despacito, coming over in my direction. So thankful for that, it's such a blessing, yeah. Turn every situation into heaven, yeah. Whoa. Another dress is color, perfume regret. It got me thinking back when you were mine. Girl, you know I want your love. Your love is meant for somebody like me. Come on now, follow my lead. Come on now, follow my lead. I wanna follow where she goes. I think about her and she knows it. But I got smarter, I got harder in the nick of time. Honey, I rose up from the dead, I do it all the time. I wanna let her take control, 'cause every time that she gets close, yeah. Oh, look what you made me do. Look what you made me do. Look what you just made me do. Look what you just made me do. Oh, I've been shaking. I love it when you go crazy. You take all my inhibitions. Baby, there's nothing holding me back. You take me places that tear up my reputation. Manipulate my decisions. Baby, there's nothing holding me. Back in the Cadillac, girl, let's put some miles on it. Anything you want, just to put a smile on it. You deserve it, baby, you deserve it all. And I'm gonna give it to you. You just want attention. You don't want my heart. Maybe you just thought of me with someone new. Yeah, you just want attention. I know from the start. You're just making sure I'm never getting over you. Despacito, I'm in love with the shape of you. It's what I like. You just want attention. Look what you made me do. There's nothing holding me back. We were victims of the chemical, physical kryptonite. Helpless to the base and the fading light. Oh, we were bound to get together, bound to get together. She took my arm, I don't know how it happened. We took the floor and she said, oh, don't you dare look back. Just keep your eyes on me. I said, you're holding back. She said, shut up and dance with me. This woman is my destiny. She said, ooh, shut up and dance with me. A backless dress and some beat up sneaks. My discotheque, Juliet, teenage dream. I felt it in my chest as she looked at me. I knew we were bound to get together, bound to get together. She took my arm, I don't know how it happened. We took the floor and she said, oh, don't you dare look back. Just keep your eyes on me. I said, you're holding back. She said, shut up and dance with me. This woman is my destiny. She said, ooh, shut up and dance with me. In her eyes, I think I see the future. I realize this is my last chance. She took my arm. I don't know how it happened. We took the floor and she said, oh, don't you dare look back. Just keep your eyes on me. They said you're holding back. She said, shut up and dance with me. This woman is my destiny. She said, ooh, shut up and dance with me. Shut up and dance with me. Shut up and dance with me. I am driving 85 in the kind of morning that's all afternoon. Just stuck inside the gloom. 4 more exits to my apartment, but I am tempted to keep the car and drive. Leave it all behind. 'Cause I wonder sometimes about the outcome of a still riding this life. I'm living it right. I'm living it right. I'm living it right. Why, Georgia, why? Rent a room and fill the spaces with world in places to make it feel like home. As I feels alone, might be the corner life crisis, just stirring in my soul. 'Cause I wonder sometimes about the outcome of the fighting this life. I'm living it right. I'm living it right. I'm living it right. Why, Georgia, why? So what? So I've got a smile on, but it's hiding the quiet superstitions in my head. Don't believe me. Don't believe me when I say I got it down. Everybody is just a stranger, but that's a danger. Going my own way. It's the price I had to pay, yeah, yeah. Still, everything happens for a reason. There's no reason not to ask myself if I am living it right. Am I living it right? Am I living it right? Why? Tell me why? Why, Georgia? Why?
Okay, just a quick check. Everyone can hear my voice?
Yes.
Okay, cool. We shall start on time. Okay, so for those who are late, all right, you'll be able to catch up later on in this recording, all right? So we actually recorded this whole session. This session is unique, all right, because together with me, next to me right now is Joan. Okay, so later I'll actually introduce a little bit about him, and he'll be sharing with you a little bit more as well as we progress. Okay, so the first thing I'd like to do is thank Pafti for actually organizing this webinar, right? Giving me the opportunity to share. And of course, this webinar is about two topics, fundamental analysis and talking about Elliott wave theory. Right. So today, everything we share, quick disclaimer, is for educational purpose, and along the way, as we have some ideas and trade setups, we might be taking it. So just make sure that if you follow suit, you have a proper plan and risk management to follow the plan itself. Okay, so for the flow for this webinar, we'll be starting at 8, spend about 10 minutes on introduction, which is what we are doing right now. Then around 8:10 to 8:50, about 40 minutes, we'll be talking about fundamental analysis, and then we go for a quick 10 minutes break. Followed by that, at 9 p.m., we'll start to talk about theory, wave theory, and then spend another about 40 to 45 minutes to talk about the topic. And then after that, we'll open up for the last 15 minutes for Q&A. All right, so if you have any questions, even for the fundamental analysis aspect, just write it down. So make sure you have certain writing materials for you, and then we'll address all questions at the end of the webinar itself. All right, so this objective of the webinar is that at the end of it, you should be able to understand what is fundamental analysis. You'll be appreciating the importance of fundamental analysis. At the same time, I think more important is to apply and combine your concept and what you've learned in this webinar about fundamental analysis into your trading. Okay, and of course, for the second part about Elliott wave theory is you'll be finally able to read charts based on wave theory and establish a directional bias at the same time. Because of that, better time your trade. Okay, so you have a better idea into when you want to take a trade, when you want to avoid trading. And of course, very important aspect is to apply the wave theory into your trading. Okay, so for the wave theory today, because of the time limitation, we won't be able to go full in-depth into every element of Elliott wave. Okay, but I would share with you what is the essence of it, and of course, the more important thing is the practical aspect of wave theory. Okay, so the idea is you do not want to just learn the concept and then you cannot apply it on your trading, right? So today's webinar is all about application at the end of it. Okay, so quick introduction, two speakers for you today. One is myself, right? So for those who are first time hearing me, I'm Kayong, currently training and trading together at this company in Singapore called Alpha Play. And next to me right now is Jovan. He's actually heading the communities, the Philippines community together with us in Alpha Play. Jovan, you want to say something? Just say hi.
Yeah, hi everyone.
Okay, so that voice is Jovan. Later, before the break and before the Q&A, he'll be sharing with you certain interesting things that we have for you guys, especially in the Philippines as well. All right, so let's get started into today's first topic, which is fundamental analysis. Okay, so I will walk through with you, all right, what is the fundamental top flow. Okay, because some of majority or the most common challenges that many traders face is fundamentals has too many things that they do not know where to start. Okay, but today after the webinar, you realize that it's actually not so complicated. So the whole idea of fundamental top flow, okay, is to start off with central banks, right? Which means that they are like your grandfather, the master of fundamental, right? So the first thing you need to understand in fundamental is you need to first know what are central banks, what central banks do, how are they going to impact the currency market. Okay, follow from there, you need to understand that central bank needs certain indicators to make certain decisions, right? So that is where they look into the economic indicators, which means how well a country is performing they need certain signs to understand, right? Is the economy doing well or is the economy not doing well, right? So they look into economic indicators. So as traders, all right, we want to understand the whole fundamental process. We also need to understand what these banks are looking at. Okay, so we also need to look into the economic indicators, the fundamental economic indicators. And last part of the fundamental analysis is after knowing these two aspects, okay, the central banks and the economic indicators, you would want to make sense of it, all right? And that is the application of after that, okay, how you're going to trade it. Okay, so today the topic on fundamental we'll be covering this three, okay, and of course we're going to start off with central banks. Okay, so the steps to understand this whole top flow, the fundamental top flow, is first you understand what central banks do. And of course, understanding that what they do is not just is not that important, right? But more important aspect is you need to know why they do it. Okay, and from there on, you will understand that they need to decide when to do it as well. Okay, so what they need to decide on whether to do something or not. So that is where I mentioned that they need to look into economic indicators. All right, so we'll walk through those as well. And the fourth step is you need to understand how they do it. Okay, so instead of just why, you need to now understand that how central banks actually make certain decisions as well. And finally, what happens when they do it, right? The impact of central bank decision onto the currency market. And last thing is you want to find out when they're going to do it. Okay, so this is basically the 6 guideline to kind of summarize what fundamental analysis is and to make your learning and understanding of fundamental analysis easier. Okay, so I'll start off with what is central banks. There are many central banks around the world. In fact, every country itself would have its individual central bank. Okay, but as traders, as currency traders, we don't trade every currencies available in the world. So we only focus on the 8 major central banks. Okay, of course, some of you might have also heard of these 8 central banks. They are mainly your Federal Reserve, right? In short, some of the traders call it Fed. Okay, so this is your US central bank. You have Bank of Japan, in short is BOJ. You have Bank of England, BOE, European Central Bank, ECB, Swiss National Bank, SNB, Reserve Bank of New Zealand, RBNZ, Reserve Bank of Australia, RBA, and of course the last one is Bank of Canadian, which is BOC. Okay, so recently, many traders also get confused between Bank of Canada and Bank of China. All right, so BOC is Bank of Canada. If you are referring or if you want to refer to Bank of China, it's actually PBOC, it's the People's Bank of China. All right, so just take note that BOC, when you read it in article and in newspaper, they're referring to the Canadian bank. Okay, huh? So these are the 8 common major banks. All right, so Joanne just reminded me, in case I'm going too fast, do voice out in the text as well. That means write in the live chat and let me know so that I can slow down as we progress. Okay, so the next thing is on top of just knowing what are central banks or what is central bank, you need to also find out or understand what is the mandate of central bank. Which means that what is the function, what are the responsibilities of the central bank? Okay, so you need to know as traders why central bank exists. So generally, there is a few functions that central banks need to maintain. Okay, so the first one is definitely price stability. This refers to ensuring that the prices of your goods and services in the country do not fluctuate too much. Okay, so imagine if your for example your bottle of water today is at $1, tomorrow is at $2, and the following day the same water bottle now becomes $1.50. That is where your price fluctuation is too huge, all right? Which means that the price of goods and services are too volatile. Okay, when that happens, the whole economy in the country becomes very chaotic. Okay, so people like you and I will also be in a panic state because you do not know. Suddenly, tomorrow the price of your water bottle becomes $2, $3, and then you can't afford it. Okay, so that will cause a lot of instability that will cause a lot of panic in the economy. So the central banks needs to ensure that this does not happen, right? And so one of their very important mandate is to ensure that your price is stable in the economy. Okay, the second mandate that they have is inflation rate targets. This is actually pretty related to price stability. Okay, so what is more important is this inflation rate needs to be healthy, which means that their function is to ensure that the overall inflation rate in the economy targets reach around 2%. Okay, so if inflation is negative or is near zero, it simply means that your economy is not growing. If inflation is too high, let's say 4%, 5%, then that is where your price of goods and services will increase too quickly. Okay, and that again causes people in the economy to panic, and therefore again causes instability. Okay, so in terms of inflation rate, most central banks in the world have a target of 2%. Okay, so 2% inflation rate target is something like a healthy growth rate for each economy. Then the next thing that they need to ensure of is your labor market, which is your employment rate, needs to be healthy, right? So for most countries, a full employment condition is considered as 5% unemployment in the economy. Okay, which means out of 100%, 100% is the total population who is seeking for job. Okay, if you have only 5% of them who is unemployed, you are already considered in the full employment status. Okay, so most of the central banks need to ensure that their people are being employed. All right, so employment rate is also one of their mandate, and the last one is exchange rate policy. Okay, so exchange rate policies are tied to your price stability, especially in today's context where the whole economy is very globalized. Okay, which means that there will be trades involved, imports and exports. So exchange rates will affect your prices of goods and services also. Okay, so the central banks, one of their function is to ensure that the currency strength don't fluctuate too much. Okay, so this is generally the four mandate that central banks need to have. Okay, so just to share with you some example, so that you are aware that I didn't pull all these mandates out of nowhere, right? So the first one is I'll share with you in terms of RBA, okay, which is the Reserve Bank of Australia. You can see the highlighted one over here. Okay, it mentioned that its duty is to contribute to the stability of currency, full employment, and economic prosperity, all right, and the welfare of Australian people, right? So the idea here is, again, they have certain mandate, they have certain function. Okay, it's the same for majority of the central bank. This is European Central Bank, ECB. So again, you see this, the objective of price stability, support the general economic policies, and of course, this includes full employment and balanced economic growth. And of course, the most important central bank in the world, which is the Fed, has the same mandate, right? So it's to conducting the nation's monetary policy, right, in pursuit of maximum employment, stable prices, and moderate long-term interest rate. So generally, all your major central banks would have that four mandate. Okay, so this is what they need to fulfill. That is their role and their function of a central bank. Right. So again, what it means in layman term is this. Okay, if your economy is too strong, central banks need to step in to prevent hyperinflation from happening. Okay, which means that if prices of goods and services are increasing too rapidly, okay, it's not good for the economy. Therefore, central banks need to step in to prevent hyperinflation. Okay, and the other way is that if the economy is too weak, right, people are not spending, there's no outflow of output of economy, that means the growth of your economy is slow, central banks then also need to step in to do certain things to prevent the whole economy from going into recession. Okay, so generally these are the two condition or two scenario that the central bank need to step in to do something. Okay, so from this point, once you understand that they have a certain role and certain function, the next step is that you want to know what are certain tools that the central bank have that they can take action on. Okay, so generally they have three tools that central bank can use. The first one, I think most of us are very familiar with this, is called interest rate. Okay, which means that central bank can decide to increase interest rate or drop interest rate, okay, in order to either encourage spending or to stop people from spending. Okay, so generally, if the central bank increase interest rate, the whole idea is to control inflation so that you will stop people from spending, all right? You will slow down the spending. And if central bank lower interest rate, is basically making borrowing cheaper, and therefore more businesses and investors would borrow money and spend it, all right? And therefore that will encourage spending and it will bolster the economy. Right, in terms of the next tool, it's called quantitative easing. In short, it's also called QE. The whole idea of quantitative easing or QE is, in layman term, print money, which means central bank releases the money into the economy. So they actually print money, right, and release those new money into the economy so that now you have a higher money supply in the economy and therefore people tend to spend. The last tool that many traders are probably not aware of is called the language tool. Okay, so language tools are actually commonly used by many central banks, which means that instead of doing certain things, the chairman or the president of the central bank would actually come out to make a statement, which means that they will call for a press conference, they will decide to speak, right, and let the market know what are their views, which means that if they want to give the market a certain negative sentiment, which means that they are not so positive. Usually, the technical term we use to describe them is called dovish, okay, which means it's bearish on the market. The opposite side of it is called hawkish, which means that the central banks are actually very bullish in terms of the economy. Right, so this language tool is very commonly used because they can't really always print money or they can't always increase or decrease interest rate. So many times the central bank, the chairman and the president would actually use language to affect the economy, and therefore the currencies will be impacted as well. So you need to be aware of these three tools, all right? And then once you are aware of it, you'll be able to identify whatever tools that the central banks are doing, and then later on you'll be able to understand how it's going to impact your currency market. Okay, so how to know what are the views of the central banks and what are they deciding to do? That is where you need to read into a little bit on the central bank meetings. Okay, so central banks meetings are very important. It usually happen once a month. Sometimes it's once every few months, right? So for example, the most common central bank meeting is your FOMC meeting minutes, right? It's usually released on a Wednesday, past midnight or Thursday morning, right? So this is very important because in this meeting minutes, all right, in those statements, the central bank will release what are their outlook in terms of the economy, what are their views and what are their decisions they're going to do. Okay, so they will discuss inside whether they are looking to raise rate, decrease rate, drop rate, or hold interest rate. Right. They also discuss their views on the economic outlook. Right. So these meeting minutes are very important. Generally, if they talk about raising interest rate, okay, your currencies would generally strengthen, and the opposite applies, which means that if central banks are talking about decreasing interest rate or going into QE, generally your currencies will weaken. Right. And the more complex part is central banks don't always raise rate or drop rate. Okay, so in the event that they decide to hold rate, it's actually a question mark because it really depends on their decision moving forward, which means in the future, what are they looking at? What are their expectation of the economy going forward? Okay, so the complexity in understanding the meeting minutes is really when central banks don't have a clear decision and they decide to hold rate. All right, so that's the part that many traders feel confused of when they see the meeting minutes stating that it's holding a current rate. Okay, so no worries about this, because as we progress in this webinar, you'll be able to decipher and understand how to read all these meeting minutes. Okay, this part here is actually a summary in visual format of what we have covered so far in fundamental analysis, right? So we start from, I'll walk you through quickly, right? We start from a better economy over here, okay, which means that the whole country's economic performance is growing very well. It also means because the economy is doing well, you get a higher employment rate. So more people are being employed. And more people are being employed when they work, they have salary, they tend to spend as well. So it will increase the spending in the economy. And because more demand, when people spend, right, demand increases, prices of goods and services increase, and that will cause inflation to rise. And because inflation starts increasing, okay, there will be a fear of overspending and hyperinflation by the central bank. They need to step in to do certain things. So they will start increasing interest rate. Okay, so when they increase interest rate, the impact on the currency market is it will appreciate, which means it will strengthen. Okay, so this is a general flow of how the economy affects the central bank decision and therefore affects your currency, right? So then the next, to close the cycle itself, all right, from here, as they increase interest rate, because of that, your currency strengthen, your exports become more expensive, people tend to spend more prudently, which means that things becomes more expensive, they don't anyhow spend, right? And then economy starts to slow back down, and central bank will be having a fear of underspending and deflation, which means economy don't grow, which might cause higher unemployment rate, and therefore central banks need to step in again. Right, so this is a visual mind map of how the economy performed and how central bank tends to step in and what will happen to the currency itself. So to sum up the whole central bank segment of fundamental analysis, right, a summary table is this. If your economic performance is poor or bad, central bank tends to lower interest rate or exercise quantitative easing, which means print money. Okay, and because of this, the effect on your currency will be generally price will go down. Okay, the opposite is when economic performance is strong or good. Okay, central bank will decide to increase interest rate or exercise tightening. Okay, tightening, the term here is opposite meaning of QE. QE is print money. Tightening is collecting money back from the economy, right? So when you hear or see the word tightening, it simply means that central banks are collecting back money from the economy. Okay, and that general impact on the currency is that currency will tend to appreciate. Right? So this is a good summary table on central banks, all right, which what we've discussed so far in this webinar. Okay, so I would sum up as to why this is important for you, right, as a trader. Okay, understanding all this is important because knowing the current and future stance of a central bank will provide us with a fundamental backdrop of the currency, right? So again, when you read this sentence, what it means is that it doesn't really give you that decision on whether to buy or sell certain currency. But it helps to provide you with a fundamental backdrop, right? So you probably hear a lot of word that I might be using, like confluence with your trade, okay? Which means that if you are buying or you're looking to buy a currency, you would want to see if your fundamental central bank, all right, are also aligned with your view, all right? So if you want to buy and the central banks are also bullish or hawkish, then you have an alignment or confluence. Okay, so the idea behind fundamental is really about combining the understanding with technical direction bias to allow us to position ourselves with the underlying forces, which is your fundamental of the market. Okay, so technical has their advantage, fundamental has their advantage as well, and of course, each of this has their own disadvantage. All right, so if you combine both, that's actually the best way to approach. Okay, so let me show you how or where you can actually look out for central banks meeting minutes. Okay, this is a screenshot taken very recently from Forex Factory. Okay, so if you click into one of the event, right, like for example, RBA rate statement, that is where you have your Australian bank, or Australia Central Bank, releasing their statement or their meeting minutes. Okay, you click into the yellow folder, you'll pop up this. You want to focus on the link source here, the latest release. All right, so if you click into it, it'll bring you to this page, which is the official RBA website. Okay, you will realize 6th February, you have this media release titled Statement by Philip Lowy. Right, so he's actually the governor of RBA. Okay, so if you click into it, it will actually link you to the whole meeting minutes itself. Okay, so what I'll do is I will quickly bring you to the example over here. Okay, so this is Forex Factory. Okay, if you click into it, let the page load a bit. Right, so you click into this RBA rate statement, click on the latest release. Okay, go over to this statement by Philip Lowy, 6th February. Click into it. That's where you get the whole report. Okay, most of the traders will feel that, wow, a lot of things to read, you might not understand and things like that. But I said that I will actually encourage you guys to start reading. Okay, it's not very long, because if I scroll down, you realize that it's slightly more than a page only, right? And if you're not that means you didn't study economy or macroeconomy in school, don't worry about that, because as you keep practicing on reading, sooner or later you actually understand what they mean. Okay, and it's not very difficult to understand. For example, I just take this. Let's say I take this. All right, the bank's central forecast for the Australian economy is the GDP growth to pick up. All right, so I think this is a very plain and layman sentence that many of us will be able to understand, which means that RBA forecast in the future is to expect the GDP to grow. Okay, so it's actually a good thing, right? And then they talk about how the data over summer have been consistent with this outlook, which is again positive things. Business conditions are positive. Outlook for non-mining business investments has improved. Increased public infrastructure investing is also supporting economy and such. Okay, so basically the whole idea of this paragraph is a positive view from the central bank. Okay, then after that, they talk about employment as well, inflation over here as well. And then they talk about everything else, right? Housing prices and things like that. Okay, and then the concluding paragraph at the bottom here states that the low level of interest rate continue to support Australian economy, further progress in reducing unemployment, having an inflation return to target is expected, and things like that, right? So taking into account the available information, the bank judged that holding the stance of monetary policy, which means that the current interest rate, the current decisions that they have done, all right, they have decided that unchanged is the decision that they want to do. Okay, so basically, again, this means that they are holding interest rate. They are not doing anything different this time around. Okay, so this is the part where you need to understand most central banks have this, which means that they decide not to do anything. Okay, but the context of understanding if they don't do anything, what will happen in your currency market, you need to read those paragraphs on top to get to understand more what are their view and what are their outlook. Okay, so if generally their outlook is positive, it will give a positive impact on your currency. Okay, if generally their view is a negative, which is not so good in the economy, then it will impact the currency negatively. Okay, so again, I won't be able to go in depth into every paragraph today. Okay, but I would really encourage you guys to take a read onto all this monetary policy decision and meeting minutes, so that you have a better understanding of what the central banks are looking at. Okay, so this is showing you example of how to assess monetary policy meeting minutes. Okay, so from here, right, what we've covered is central bank. Okay, so now I will move on to economic indicators, right? This is actually slightly easier for you all to understand because it's pretty straightforward. Many of you who who have been trading the FX market or currency market would have already come across economic indicators. Okay, central banks look into them, so we also need to look into them as traders. Okay, the first thing you need to understand is different countries may be looking at different economic indicators to determine what they want to do. Okay, so for example, I'll give you one economic indicator, which is, let's say, unemployment rate. Okay, not every country would be focusing heavily on unemployment, right? So some countries might be more concerned on inflation, while some countries might be more concerned of employment, right? So depending on the countries that we are referring to, and depending on where the countries are in terms of their economic performance, the central bank will state clearly what they are looking at. Okay, so different countries and different central banks look at different economic indicators. So give you an example. Okay, US is looking at unemployment data and inflation rate to determine if they should raise interest rate. Okay, afterwards, right, that means once, let's say, this data has been fit, which means employment data has been good, inflation rate has been good, okay, they may shift their focus towards, let's say, consumer price index, okay, to see if consumer spending have been increasing and consumer have the confidence to spend. All right, so that is the part where you need to know at one stage the Fed might be very focused on employment and inflation. Then after that, the Fed might start to look more towards consumer price index. Okay, so depending on which data the central banks are focusing on, that particular economic data or event would have a more significant impact on your currency market. Okay, so for example, let's say another bank, right? ECB may be looking at employment data because of certain concerns that they have within their Eurozone itself. Okay, so this is where you need to first read the central bank meeting minutes, then you know which country is focusing on which economic indicators. Okay, so on top of that, you also need to know that because of different countries focusing on different economic indicators, and different news therefore would also have a very different impact on your currency market. And impact here, we are also referring to the terms or in terms of duration of time. Okay, so what I mean over here is, for you to understand, is, for example, the very popular news that a lot of traders trade are NFP, right? Non-farm payroll. So the idea about this is depending on whether the Fed is having a huge focus on the NFP data or not, right? So for example, if Fed is focusing a lot on NFP, okay, and the NFP data is very positive, the impact on your dollar, the US dollar, will be very great, right? And the duration of the impact might be longer compared to, let's say, the Fed now don't really look into NFP anymore because employment rate has been full employment, so they don't focus so much on NFP, right? And therefore, the impact on NFP on your US dollar would be lesser, and the duration of the impact will be way shorter. Okay, so again, all this understanding needs to start from central bank. Okay, so that's why we actually cover central bank first. So again, for example, negative NFP report is likely to have shorter term effect in comparison to the Fed saying that they will raise interest rate 4 times over the course of a year. Okay, so you need to understand that yes, NFP is important, but you need to put it in terms of whether the Fed is still looking at it. Okay, so for example, another one, Bank of Japan announcing QQE, which is print more money, right? Print money, is likely to have a longer term impact on Japanese yen compared to some good economic data coming out in a very short term. Yeah, so you need to understand that different news have very different impact. So generally, okay, we have a lot of economic news in the currency market. Okay, but we can generally categorize them into 2 categories. Okay, one of them is label data, okay, on your left over here, which means that every economic data, every economic indicators that deal with employment related stuff. Okay, like NFP is labor market, unemployment claims is also label data, unemployment rate is definitely labor data, and Clement count change, which is a very unique name for the UK market. right, which is something very similar to your NFP. Okay, so this is all labeled data. Then you have the inflation group of data, which is your GDP, consumer price index, CPI, retail sales, manufacturing index, new home sales, and average earning index. Okay, so generally all the economic indicators you find in Forex Factory can be categorized into either label or inflation. Okay, so this is the part is this categorization of data, okay, of risk event makes it easier for you to understand. For example, right now in today's context, okay, US is already in full employment rate, which means that labor data becomes less important. Okay, and inflationary data becomes more important in the US, right? But if you compare it to, let's say, Eurozone, right? So Eurozone employment rate is still pretty high. Their inflation is also low, which means that ECB will focus on two of this category, but the Fed will have more focus on inflation. Okay, so this is the part where knowing how to categorize the data helps help you to make things easier as well. Okay, so this is a very common screen that I think many of you will be very familiar. So, okay, this screenshot, the background here is taken from Forex Factory. Okay, what you need to know to walk you through, right? This is basically the date and time of the release of the data. Related currency is stated here as well. The name of the economic event that is happening, and of course, the more important one here is you have your actual, forecast data, and the previous month data release. All right, so if it's a weekly data, this previous data will show you a weekly one. Okay, if it's a monthly data, then this part here will show you the previous month. Okay, I think many of you are familiar with this, but I want to point out that as a trader, we always only look for, oh, if it's red, then it means it's bad for the economy, or if it's green means it's good. Okay, I want you to start to see it slightly differently, because if you really understand fundamental analysis, right, you don't only look at one individual data. For example, industrial production for China, this one is 6.5. All right, so then it's red in color, then you straight away say, oh, it's bad for China economy. Okay, it's actually not so straightforward. That means not red and then you go and sell the currency, and then green you buy the currency. Okay, so this is the part where later on in this webinar, in a minute or two, I'll actually touch on that, right? How to look into this actual and forecast. But just take note that at this point in time, doesn't mean red you sell, green you buy. Okay, so you need to understand the fundamental backdrop of what the central banks are looking at. Okay, impact on risk event. Okay, so this one here, I think I have been repeating this for some times already, right? So related currency usually strengthen when actual data is released. Actual data release is better than the forecast, right? Just now I mentioned, but doesn't mean you buy. Okay, so it's usually the case, but doesn't mean you buy. The opposite is also that if the actual data release is worse than the forecast, which means usually on Forex Factory they will put it as red color. The currencies that's related usually will weaken. Okay, but again, these are impacts of risk event. But if you decide to just take this and go and trade every time you see a red, you sell. Every time you see green, you buy. Most likely you're gonna lose more money than you're gonna make. All right, so don't do that. Okay, but the impact here is generally this happens. So to give you some understanding of it, right? Because more important is for you to note that when this data are released, how the overall economy is going to be impacted, right? This is actually more important. Okay, so the idea here is you need to build from understanding the backdrop of central bank, which data is more important, focus on those economic data, right? If we want to follow what the central banks are looking at. Okay, so with this, so far what I've covered is understanding of central bank. Okay, and we have just covered economic indicators, all right, the categories of them, what are some of the impacts that they have, and how central banks actually look into these economic indicators to make certain decisions. Okay, the last of it for this part of the webinar is to really make sense of what we have covered in these two sub-chapters, right? The central bank and economic indicators. now it's time for us to make sense of it and see how we as traders can actually capture and trade it. Okay, so putting it all together, okay, price tends to react, right, when there's an economic news or risk event that's being released. You need to understand why there is an impact, right? So the impact is because this economic news or risk event, when they are released, all right, is a new set of information for the central bank, right? So because when there's a new information from central bank, it will also impact what the central bank is going to do. Okay, so if the economic news is positive, okay, it means that economy is growing, and therefore this piece of information which is new to the central bank will cause the central bank to think economy is growing, so maybe I will need to increase interest rate in the future. Okay, and because this generally follow through, the traders who are trading the currency market will start to price in that in the future central bank will increase, and therefore they buy. Okay, and when traders are buying, the price of the currency tends to increase. Yeah, I would repeat this in another example, which is if the economic news is bad. Okay, so let's say, for example, your CPI, which is an inflation data, comes in negative or comes in worse than expected. Okay, this means that the economy is slowing down, and this information is new to the market, which means that central bank now has one more new data, which is CPI, not so good. Okay, this will cause the central bank likely having the need to decrease their interest rate or exercise QE in the future because economy is slowing down. Okay, and once traders understand that central bank will likely do this, they will start to sell, and when they sell, price tends to drop. Okay, because traders starts to price in the future. All right, so price in here basically means that they expect certain things to happen in the future, and therefore they take action right now. Okay, so in the event that it really happen in the future, they will be able to profit from it. Okay, this part here, when I talk about price in, I want to share with you this quote by Bill Miller. Okay, he said this. I often remind our analysts, so he actually runs a hedge fund. Okay, I often remind our analysts that 100% of the information you have about a company. Okay, so in this case, you can replace this word company with any related things that you are trading. So if you are trading currency, okay, then this company here, you'll be replaced it with, let's say, economic data or news. Okay, so if you are okay, so again, I often remind our analysts that 100% of the information you have about a news, right, or a company represent the past, right, which means that if you only look at data, news, economic performance that has been released, okay, you are basically looking at the past. Okay, and that is where the information that many traders focus on. But 100% of the stock valuation, or in this case, your currency's valuation, okay, really depends on the future, which means that many of the times we only look at historical data, and then we decide to trade based on historical data. That is not the full picture that you should have. Okay, but what you need to have is over here. Okay, majority of the traders focus on event and data that has already happened. Okay, because it's tangible and concrete. It's easy because it's already happened. All right, and why we tend to do this is because as human, okay, we want to have a certain sense of certainty. This makes us very comfortable. All right, so therefore we always work with data that is already out, historical price, historical data, because it's tangible, it's concrete, it makes us comfortable because it gives us that sense of certainty. Okay, but the key in developing your insight, all right, or your forecast is really about the ability to look past just the historical data, but to weigh on the future possibility. Okay, so to put into the context of trading, okay, is you want to actually look into, let's say, the historical economic data that's been released, okay, but not trade based on those. All right, the idea is you now analyze what are the economic data that's released, okay, take them, understand how would central banks make a certain decision in the future. Okay, so for example, if the overall economy is doing bad, okay, now you understand central banks would likely gonna have to drop interest rate or do QE in the future, right? So you want to take action based on the possibility that central banks will do something in the future. Okay, so going forward, you as a trader, you might want to start focusing on the future and use the past as a jumping off point, which is what I just described, right? Use the historical economic data to understand what would the central banks likely do in the future, right? And then you trade based on that piece of analysis and that piece of information. Okay, this one here, markets are future discounting machines, all right, which means that every price that you see today, okay, has already been priced in of what has happened. Okay, so the idea is if the economic data is bad, right, it is probably already priced in, so don't go and sell it anymore. But if the data is bad and you analyze it and understand that central bank is likely going to act on it in the future also, then you can still sell it. All right, so the idea is always look into what is going to happen in the future. Okay, so here to sum up the whole portion of fundamental analysis, okay, first is to focus on bigger picture, okay, which means that you always ask yourself this question, okay, how is the overall economy performing and what are the bias of the central bank? Okay, which means that you don't look at only one piece of event or you don't only look at one piece of news. You need to look at how that news affect the overall economic performance, all right, and what will the central bank do about it. Okay, so this one here, I put here, each economic indicators or risk event is like a piece of puzzle itself, right? So you imagine you have a jigsaw puzzle. Each of the news and economic indicators is one piece of that puzzle. Okay, so if you put all these pieces together, you get a complete picture, right? But you cannot only guess what the picture is with a piece of the puzzle. You need to put everything together. Then you can see, oh, that is what picture the puzzle is forming. All right, so this is something you want to take note of, what we've covered. Next is to look for opportunities to trade the surprises in the market. Right, so this one here is actually something that I want to talk about, referring back to your economic data in Forex Factory. Okay, so give me a moment. I'll bring you to the Forex Factory to share more a little bit, but I'll walk you through this first. If everyone is expecting a positive data, okay, but the actual data is bad, okay, this is where it's a surprise in the market because everyone expect good, then the actual one is bad. All right, so what it means is that market will need to kind of like reprice itself, and therefore price will move more significantly. Okay, so if I bring you to what I mean, so I'll bring you over to Forex Factory. Okay, so if I look into the calendar and let's say forecast and actual. Okay, so the idea here is if let's say I'll pick one example. Okay, over here, this forecast is 2.3. Clement count change. All right, positive number means not so good. Okay, so Clement count change, the forecast is 2.3. Okay, the actual one came out is a negative number. So people expect a bad economic number. Okay, but the actual one is good. Okay, so this is what I mean by surprises. Okay, so this kind of impact on the currency market will be greater than your usual one. Like for example, unemployment rate here is 4.3. This one here is 4.4. This is a slight change. Okay, not huge, right? But let me give you a better example of this one. German IFO business climate. Expected come in at 117, actual is 115, right? Both of these are positive number. Just that this is red is simply because this is just slightly lower than that. So this kind of event, will not have much impact on the market, right? So again, not ideal to trade the surprises, right? So this one, another example, Canadian core retail sales, expect 0.1 came in negative. Okay, so expect better data, but the actual one is very worse off, right? So this is where we call surprises in the market. Okay, so if I go back to this point here, the idea is, okay, to trade the surprises in the market, you can look for short-term opportunity, right? So this is what I mean. If you want to trade based on a fundamental risk event. Okay, the last part, which is actually something more attractive to many traders, is to look for alignment to ride the trend and profit bigger in the currency market. Okay. So for example, if you are looking to buy, or your technical analysis, your trade plan tells you to buy, and the fundamental aspect of that particular currency actually aligns with your trade direction. Okay, what you want to do is you want to ride on the trend as much as you can until proven otherwise, right? Which means that this is more of combining technical analysis with fundamental analysis, okay, giving you a better risk to reward trade, because you have fundamental aligned with your technical. You can go for the bigger home run trade. Right, so that is the part on fundamental. Okay, again, reminder that we'll leave all Q&A at the back. Right, we have a Q&A session. So if you have any questions, do write it down on your piece of paper or things like that. Right, and then ask those questions at the back of the webinar. Okay, so right now I will pass on to Jovan. He will share with you some interesting freebies that we have for you guys as well.
Yes, thanks, Kayong. Wow, that's a lot of information. So yeah, just a reminder. Please do take note of your questions, and then you can post it so that we can answer. Or maybe you can post it in the chat right now, and then we can pick a few. But what I want to share with all of you, okay, so I've been working with Kyle for quite some time, and I really know that he is a very, very generous person. So he created a report actually that he wanted to share with all of us. So we discussed about fundamentals in the first part, and then the second part we'll be talking about the wave theory. So in order for all of you to really understand both, right, he actually created a document. He analyzed the currencies, some currencies, some very good currency. He calls it the trade of the year. So meaning this currency will basically move in one direction in like thousands of pips. And it can be like the trade that you only take for this year, and you'll be very, very good. So what I will do is post in the link, post in the chat the link where you can download the file. So maybe you want to put in the and yeah, oops, remove any.
Can't put.
Oh, okay. So it looks like I cannot put. Maybe you can put in the.
Yeah, I'll put in
the presentation. Okay, it's a bit long. Hold on, I sent to your WhatsApp.
Yep.
So this report can open up.
Let me just paste it in. And I'll open up.
Yeah. All right, so it's a bit long. Sorry for that. Next time I'll use Bitly to shorten it. But basically, this is the report, and it's what Karim calls an FX Edge report. So in the report, there are analysis using the wave theory, where you can actually enter and where do you expect it to go. So that's like basically giving you everything. But of course, what we learned from the first part, which is the fundamentals, what they teach us actually, is that we wait for the fundamentals to actually prove, like confirm our bias, so that it goes to that direction. So anyway, I hope everyone got the link already, and if not, I'll send it to all of you guys to your email later on. But please use this. You can actually use this for the next, I think, couple of weeks,
Yeah.
and see how the price develops based on this analysis, and you can see how the wave theory works. And for me, basically, I've attended the program, various, and it changed my trading in a different level. So I hope you guys can also see that using this report. Yeah. We have about 3 minutes left, and then we will start the next part, which is the wave. If you have any questions, maybe we can answer one or two. You can post it in the chat group.
Give 5 minutes.
Okay, 5 minutes. We have 5 minutes to answer questions.
Yeah. Well, for those who needs break, we'll just take this 5 minutes for a break as well. Because we also understand that if too many informations are given to you, you probably suffocate. You can't breathe, right? So the idea is, if you need like a washroom, toilet break, need to grab some water, feel free to do that in this 5 minute.
Yes.
Right. And then if you have questions, consolidate those questions. You can start posting those questions into a chat group, so later Joanne can take a look. And I think some of you might have similar questions. All right. So if you post them there now, Joanne will help to consolidate those questions, and later we can do a quick Q&A, so that you don't type in when the Q&A session is happening, so you save time on that as well.
Yep. All right.
Okay, so we'll take the next 5 minutes, listen to some music.
Yeah.
It's our party, we can do what we want. It's our party, we can say what we want. It's our party, we can love what we want. Kiss who we want, be who we want. Red cups and sweaty bodies everywhere. Hands in the air like we don't care. Cause we came to have so much fun now. Got somebody here that might get so down. If you're not ready to go, can I get enough? We go all night till we see the sunlight. Oh, we like to party, dancing with my feet, doing whatever we want. This is our house, this is our room. We can't stop, we won't stop. Can't you see it's we who own the night? Can't you see it's we who got that life? We can't stop, we won't stop. We run things don't run. We don't take nothing from nobody. Yeah. It's our party, we can do what we want. It's our party, we can say what we want. It's our party, we can love what we want. Kiss what we want, be who we want. To my own girls here with the big butt, shaking it like you at the show. Remember only God can judge us. Forget haters, 'cause somebody loves you. Everyone in line for the bathroom, trying to make their way to the washroom. We are so turned up, get turned up, yeah. We like to party, dancing with my lady, doing whatever we want. This is our house, this is our room. We can't stop, we won't stop. Can't you see it's we who own the night? Can't you see it's we who got that life? We can't stop, we won't stop. We run things don't run. We don't take nothing from nobody. Yeah. It's our party, we can do what we want. It's our party, we can say what we want. It's our party, we can have what we want. Kiss call me all friendly, telling me how much you miss me. That's funny, I guess you heard my song. Too busy for your business. Go find a girl who wants to listen. 'Cause if you think I was born yesterday, you have got me. So I cut you off, don't need your love. 'Cause I already cried enough, I've been done, I've been moving on. Since we said goodbye, I cut you off, I don't need your love. So you can try all you want. Your time is up, I'll tell you why. You say you're sorry, but it's too late now. So save it, get gone, shut up. 'Cause if you think I care about you now, well, boy, I
Video,
don't give
Google
a
Shorten.
fuck.
Can try that.
I remember that weekend
Can
when
you
my
just
best friend caught you creeping.
for your
You
this
blamed it
page?
all on the alcohol.
Don't.
I made my decision, 'cause you made your bed, sleep in it. Play the victim and switch your position. I'm through, I'm done. So I cut you off, I don't need your love. 'Cause I already cried enough, I've been done, I've been moving on. Since we said goodbye, I cut you off, I don't need your love. So you can try all you want. Your time is up, I'll tell you why.
Cannot be right.
You say you're sorry, but it's too late now.
Yeah, thank you.
So save it, get gone, shut up.
Oh, maybe I remove the
If you
HTTP.
think I care about you,
You can start.
boy, I don't give a fuck about you. No, I don't give a damn.
Quite smart, so I think they
You
carry them.
keep reminiscing on when you were my man, but I'm over you. You say you're sorry, but it's too.
All right. Okay. We extended 2 minutes of it, right? So hopefully you get a better break, huh? Okay, we do have some questions, right? If you still have, keep them coming, all right? But we'll tackle those questions at the end of the webinar, okay? So that we make sure that we don't overrun, so that everyone who allocated the 2 hours of their time, right, to listen, they actually get everything. Then we'll have the section on answering question all at the back. Okay. Now we'll move on to the topic on wave theory or Elliott wave theory. Okay, so I would use TradingView chart to actually cover this whole segment, right? Because a lot of technical aspect, a lot of drawing. So instead of a PowerPoint slides, the better way to do it is directly through TradingView. Okay, first thing I would like to point out regarding Elliott wave is that many mistakes, right? Or I would maybe not mistakes, but many times I see traders when they start to learn about Elliott wave is including myself, right? In the past, I also have this mistake, which is that we focus too quickly or we focus too much on counting or I would say labeling the wave, right? So every time you would see, Elliott wave people do this 1, 2, 3, 4, 5, and then they would start to see how they can put in the labels or how they can start to count, or is this a 1, 2, 3, 4, 5? Is this a ABC and etc. Okay, today what I want to cover with you is to take away all those ideas of counting wave, all right? Because that is not going to help you in making trade decision, right? And honestly, that is not going to be the most important element in the theory itself. Okay, so a lot of people focus on that, and therefore makes it very difficult for them to understand what the wave theory is, and then they straight away say, oh, it's too difficult, and then they give up learning. Okay, but today, what I'm going to cover and share with you will actually give you a very different perspective of the Elliott wave theory. Okay, and more importantly, is to cover with you the essence of it. Okay, so it's more like the important element of what Elliott wave theory is about. Okay, so the first thing you need to understand is in Elliott wave theory, okay, that is basically a technical analysis. So the thing that you want to focus on is a price chart. Okay, the piece of information that you can see in the price chart, okay, is basically your price over here, okay, which is your vertical axis, your price, and your horizontal axis is your time component. Okay, so in all price chart is two-dimensional, 2D. You would have price and time, right? So the idea over here is you would have, okay, so I'll write in a little bit. Okay, you would have price element and a time element in a price chart. Okay, so when we look at the chart, right, what we want to focus on is how price move and how the time it took for it to develop. Okay, and with these two elements, okay, when we combine them, we either will form, okay, what we call an impulse move or a corrective move. Okay, so what's the difference between these two in terms of impulse and corrective is this? Okay, we use price and time element to define whether is it an impulse or is it a corrective. Okay, so if I draw example for you, okay, this is one swing, two, three. So this is a three swing move. Okay, and I draw to you another three swing move that looks like that. Okay, so these two, you can clearly see that first in terms of price element, okay, this part here, the price range is actually significantly greater than the price range here. Okay, the next thing you want to focus on is time element. Okay, so you realize again, in terms of time element, this one here is about 126 bar, right, written over here, and this component here is about 132. Okay, 133. So this one here is actually shorter, this one here is longer. In terms of price, this one here is bigger, this one here is smaller. Okay, so how we categorize this is, if I remove everything, okay, a move that is strong and fast, okay, in any direction like this, okay, we call this an impulse move. Okay. A move that is slow and it takes a very long time, this move, we call it a corrective move. Okay. So this is the first and most important concept that you need to understand in Elliott wave, okay, or I would say in wave theory, which means that before you even start to go into more advanced stuff like understanding how to count wave, whether is it a ABC or is it a 1, 2, 3, the first thing you need to understand is this essence, whether is it an impulse move or a corrective move. Okay, so now with these two types of move, okay, you basically can't see another one. So in all price chart, you only can categorize them into either an impulse move or a corrective move. Okay, so now if I bring you out a chart, okay, you can clearly see that some moves are very obvious impulse, some moves are corrective. Okay, so just based on this scale of the chart and this particular time frame, right? So if you look at this move here is definitely very fast and very strong. Okay, and this, therefore, we categorize this move here as an impulse move. Okay. And then what you realize is after this, okay, this whole portion that price has been developing, you realize that the price element on the chart is smaller, is significantly smaller than the previous one. Okay. And the duration of it, okay, which means the time element on this chart you can see is significantly bigger than the other one, okay, than this one, right? So this here is what we categorize it as a corrective move. Okay, so visually you can see that it's very obvious. This is strong, and the duration of it is shorter than this, right? So if you want to have a more precise measurement, okay, this takes about 183 bar. Okay, this whole portion here takes about 418 bucks, right? Roughly around there. You realize that very obvious. This rectangle area, okay, the duration, the time element is way longer than the other one, right? So this is where we define this as corrective. We define this as impulsive. Okay, so again, if you look at the most recent price development, okay, this portion that is falling is very significant, all right? In fact, this one here is also very significant. So this one and this one here, okay, we will label or categorize the move as impulsive. Yeah, so let me bring you to another chart to give you more example, right? So like, for example, we look at pound dollar. Okay, so again, if you look at this, okay, from the recent top to the recent bottom, okay, you can see that this is the most recent top, this is the most recent bottom, right, on this particular scale and time frame. This move here is fast and strong. Okay, so this one here will be an impulse move. Okay, this will be an impulse move. And following that impulse move, what happened next in this component over here? You realize that the price element compared to the previous move here, this one is smaller in terms of price element. Okay, this move will then categorize it as corrective. Okay. From there on, you realize that this move down relative to this, you can see this move here that I drew in, okay, is again stronger and bigger than this rectangle box. Okay, so then this becomes another impulse move here. Right, following that, this move here, this new square box or rectangle box is again in terms of price element smaller than the previous one, and therefore this becomes a corrective. Okay, and you realize that this one huge candle down, okay, is actually a Brexit, right, which is very fast, very strong. Again, this becomes an impulse move. Okay, and then after that, you would have this consolidation or this square box again, and that square box is again categorized as a corrective move, and the last one to hit the low is again a strong move down, right? And this again is an impulse move. Okay, so in all price chart, we can look at them as impulse or correction, and this part of identifying, which means training your eyes to visually see impulse and correction, it takes some time for you to practice it, okay, but it's very important, okay, because if you are someone who eventually really want to learn about Elliott wave, okay, this fundamental understanding of impulse and corrective is your building block towards really trading and looking at Elliott wave more successfully. Okay, if you cannot first identify what is an impulse, what is a corrective, you will struggle a lot in trading Elliott wave. Okay, so this one is like the first thing that you want to train yourself to look in before you even start counting wave, right? So this is the most important, most fundamental aspect of Elliott wave. Okay, so again, if you look at this part here, right, this portion, how would we look at it? Okay, so this portion here, again, if you look at this scale, okay, this, I'll change the color a little bit. Okay, let's take green. Okay, this portion, okay, you can see it as one group, okay, which means the green color becomes one big impulse move, right? And if you put that into perspective, okay, whatever it's doing over here, okay, first we acknowledge that the price element of this is pretty strong, okay, but what you compare is the relative move of this versus the previous one in green over here. You realize that this here is still smaller than that, right? So in other words, this green line here that is developing is still at this very moment considered a corrective move relative to the previous one. Okay, so you realize that I use this word relative, which means that you need to work on impulse and corrective to identify them. You need to work on what has happened in the past. All right, so that is where you need to compare a little bit. Okay, again, I bring you to, let's say, another one to look at it. Okay, let's say Aussie dollar. Okay, this one here, I think it's very obvious. Okay, on this scale, this is your impulse, this is your corrective move, this is your impulse, and whatever is doing right now is corrective. Yeah, I think this one, everyone should be able to see that, right? Impulse, very strong move. The duration of time is shorter. This one, very slow in price movement. The duration of time is longer, therefore corrective. Okay, impulse, corrective, impulse, corrective. Okay, with this now, some of you might start to think, oh, if price does an impulse, okay, so that means you all might start to think that if price give me an impulse move, I would expect or always see a correction or corrective. It's not true. Okay, so I don't want you to start looking at chart and think that, oh, every impulse will follow by correction and every correction will follow by impulse. Not the case. Okay, so in this first segment that I want to cover and want you to take away is, do not combine the concept of impulse must come with corrective. Okay, look at them independently, which means impulse is an impulse, correction is a correction. Don't say that, oh, after an impulse must be a correction, or after a correction must be an impulse. Don't link the two of them, okay, but only look at the chart in terms of, is this an impulse or is this a correction? Yeah. Hopefully this concept is simple enough for you to understand what we mean by impulse, what we mean by correction. Okay, so in terms of drawing, okay, so if I use a brush, every time I want to signify an impulse move, I'll actually draw a straight line. Okay, so this arrow means impulse, right? So you need to be familiar with my drawing because I'll be using this a lot in the chart and throughout this webinar. Okay, to describe a drawing of a correction or corrective move, I usually do like that. Okay, which means that if you see a lot of up and downs that is doing like that and then followed by arrow, this is what I mean by correction. This is illustrating impulse. Okay, so this means impulse. This one here means corrective. Okay, so through this drawing, you will also understand that corrective move, they have this very unique characteristics of overlapping. Okay. What I mean by overlapping is its price tends to go up, come down, retrace very deeply into the previous move, go up, but didn't break a lot of the previous move, and then it retraced very deeply again. It goes up, break a little bit of the top, it retraces very deeply. Okay, this is what we mean by overlapping, right? Because if you draw in your pivot low and high, you realize that the retracement of each of this dip is very deep, right? The retracement is very deep. So this is what we mean by overlapping. Okay, to show you on a chart. Okay, this portion here go up, retrace, go up, retrace, go up, retrace, go up, retrace, go up. You realize that this is the characteristic of overlapping. Okay, which means that this whole portion here that I circled is a corrective move. Because of a lot of overlapping, the price element of it is significantly smaller compared to this move. Yeah, so I think this becomes clearer. Okay, and if I want to give you a quick conclusion of what is impulse and correction, okay, impulse is this: price move strongly and very fast in a direction. Okay, so this is definition of impulse. To define corrective, okay, it means that price move slow and not much overlapping in one direction. So this is a quick summary of what is an impulse move, what is a corrective move. Again, this portion corrective, this portion impulse, this portion corrective. Okay, again, reminder not to mix up that, oh, if it's an impulse, it will follow by correction. Okay, not all the time. Okay, so just take it as this. As of now, you need to fully understand what is impulse, okay, what is defined as a correction. Okay, not all the time you get impulse and correction, right? So if I show you a chart that can give you few impulses at the same time, okay, look at this. This is a very strong move down. Okay, this is a very strong move down. This is a very strong move up. This is a very strong move down, a very strong move up, a very strong move down. Okay, so again, this here can give you impulses as you go along. Okay, it doesn't need to be impulse followed by correction. Okay, this is I will go further into this concept as we progress. All right, but as of now, you need to be very clear what is the definition of impulse, what is the definition of corrective. Okay, so again, if you have any questions, make sure you write it down in your note so that later you can clarify. Okay, now I would like to go through building up, right, from your understanding of impulses and corrective move. There will be a total of 3 scenarios for you to take note. Okay, that means in the market, there's generally only these 3 scenarios. Okay, first scenario, you would see an impulse followed by a correction. Okay, so this is how I draw it. The second scenario, you would see an impulse combined with another impulse up. The third scenario, you would see a down move impulse followed by a correction like this, but this correction is going against the previous trend. This one here goes like that. Okay, if you look at this, there's no other way the market can move now, right? Of course, the opposite is this is up impulse, a correction down. Okay, and then this one here is an up impulse followed by a down impulse, and then this one here is an up impulse followed by a correction upwards. Okay, so if you look at this, there's no other way the market can move, right? So this is what I call 3 scenarios that can happen in the market, right? Of course, 3 bullish, 3 bearish, 3 bullish. So total you would have a 6 kind, all right? So this part here, this is one group. Okay, so like that. Right, so this part here, I want you to understand that this concept is also very important in wave. Okay, because these various scenarios is like your puzzle piece. Okay, that will build up in your understanding of how to count and label wave, right? So this part here is if you can't identify impulse and corrective, you can't identify these 6 scenarios. And if you cannot identify these 6 scenarios over here, it's very difficult for you to identify whether is it a 1, 2, 3, 4, 5 or ABC or etc. Okay, so you realize that in Elliott wave is you need to build up from the basic and very important understanding before you start to go and count it. All right. So today we'll cover a lot of all this essential aspect of wave. Okay. So this tree here, I'll take a screenshot. Okay. So that later we can refer back to these 3 scenarios. Okay. Right now, let me go back to using one example. Let's say the dollar index. I want to show you how this are plugged in, all right? These different scenarios over here, how you see and identify it in the chart. Okay, I would use a lower time frame one to share with you. Okay, so we have more data points to play with, huh? Yeah. First, let's focus on this starting point here. Okay, change it to light blue. Okay, this starting point here, all right, so if this is the most recent high, okay, you will realize that this drop here is your first swing down, okay? So this first swing down here moved pretty strong and fast, and the next move that happens over here, okay, is a corrective move compared to this one because first you look at the price element is smaller than the previous one. Okay, so this becomes your corrective nature, right? Again, if you match this to your scenario, you realize that this is your first one here. Okay, impulse down followed by a correction up. So this is your first scenario. Okay, let me show you your second scenario over here. Can you see this? Down, impulse, up, impulse. Okay, so this here is an example of this part. Yeah, so let me find the third scenario for you. Let me find obvious one. Okay, this one. Up impulse, a corrective up move. The third scenario, this one. Okay, so you realize that you can actually see all this movement on the actual price chart as well, right? As I just identified to you the 3 element, okay, the 3 scenario. Okay, so this one here, why is knowing this or being able to identify which is price developing, why is it important? Is because these scenarios here give us what we call a directional bias. All right, so let me go back to my drawing. Did I miss it? Okay, I'll draw it again. Okay, so why this is important, let me repeat. First, let's talk about the first scenario. You have an impulse followed by a correction. Whenever you see this kind of scenario, right, a strong impulse followed by a correction, you would want to expect, okay, that there is a higher possibility that price will do this, okay, which means that you get impulse, correction, impulse. Okay, so when you see this move, impulse followed by a correction, okay, this is what we call establishing a bearish bias. Okay, if you see this, you get a bearish bias. If you see the opposite, which means you see an up move, impulse, and a corrective correction down, this forms a bullish bias. Yeah, so meaning that if I see this happening, I would be interested to look for short side. Okay, if I'm seeing this happening, I would have a bullish bias and I'm be interested to look for the buy side, which means that I won't be interested to sell it when I see this scenario, and I won't be interested to buy it when I see this scenario. Yeah, hopefully so far you guys are clear with the first scenario, okay, which means when I see this scenario, the first one, either a down impulse and then correction, or an up impulse followed by correction, I would have a bias to it. This one here, the first one, I would have a bearish bias. This one here, I would have a bullish bias. Okay, so this one here, I have a bias to it. Now, if I go on to the second one, which is second scenario, I see an impulse down followed by impulse up. This is like a V shape. Okay, this is your second scenario. So whenever I see a second scenario, this is where I say no trade, or I would say no clear bias. Right? The idea behind this is because every time you see a V shape, or it can be an inverted V shape, okay, you do not want to take a trade because you are not clear as to whether from here price is going to go higher or price is going to come back down. Okay, so there's no high probability. It's like 50-50. So you do not want to take that kind of trade. Okay, but actual fact is actually not 50-50 because price can do three things. Okay, it can do this, it can do this, or it can do this. Okay, so in fact, you only have about 33%, okay, of probability of each of this scenario. So when this happens, okay, I do not want to take a trade, which means that when you see impulse and another impulse follow that, okay, it's called a no trade or no clear bias. That means when you see this scenario, avoid or wait for more information. Don't have a bias established. Okay. Now this one becomes very clear. Huh? So the third one that we want to look at, okay, the third scenario is an impulse down followed by a correction in the direction of the impulse. Okay, so this one here can be also up impulse and then a correction in the direction of the impulse. Okay, this kind of bias is called a reversal bias. Okay, which means that you would want to expect that when you see this here, for example, okay, you would expect price to make a reversal to the upside, right? Because this is moving down, 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 you expect it to reverse. This one is going up, you would expect it to have a reversal. So this, when you see the third scenario, we would have what we call a reversal bias. Okay, which means that if you're looking at this down move, a strong impulse down move followed by a corrective down move, okay, this becomes a bullish reversal bias, which means that I'm not interested to sell. I'm only interested to look for buy side. This one opposite. If you give an impulse up followed by a corrective up, okay, this one here, I'm only interested to sell. I'm not interested to buy. Okay, this pattern, okay, over here, we always use this term called crawl. Okay, so it's like a crawl pattern. Okay. You probably won't be able to find this because this is not a classic technical name, but it's just basically a name to define how price is moving. It's like it's crawling down. There's no more strength to it, right? It's going down very slow. There's a lot of overlap. Okay, so this is what we call crawling. Okay. The closest technical term that you can find that kind of define what this move is called diagonal. Okay, so it's called a diagonal in a classical technical terms, right? So put it more layman, we call this a crawl pattern, right? A crawl down, a crawl up. Okay, so let me show you some of the example of this happening, right? For example, let's go to euro dollar. Okay, so whenever we see this, right? So for example, if I work on this chart, okay, starting from the very low, okay, price went up. Okay, it does a correction. It didn't break the previous one, which means the price element is lower. Okay, so you realize that every time it does an impulse up, a correction, there's a higher possibility of doing this. Okay, that means impulse up, correction down, higher possibility of going up another time. Okay, then this part here, from here you see this is an up and down very strong. Okay, so this down here becomes an inverted V. So don't do anything. And you realize that after that, it does another strong up move. Okay, from this strong up move, the next thing it did was a correction, which is your first scenario. Okay, so you have an impulse, a correction, very high possibility it will do another impulse up, a correction, another impulse up. Okay, so this becomes a bigger correction for this impulse, and then after that, it does another impulse up. Okay, so as of now, this price here, what you are seeing is still a correction, right? So that's why you see very slow and it's not going anywhere, and there's a lot of overlap. Which means that for euro dollar, okay, based on this analysis here, right, you would be expecting one more up, which means that impulse, correction, upside, your first scenario. Yeah, so this is the example when you apply it onto a chart, right? Very quickly, you can give you that direction whether to buy or sell. Okay, so now let's take a look at, let's say, USD yen. Another example, huh? Okay, look at the most recent one, right? Don't need to look so far back. This is a strong move down. This is a V shape. Okay, so don't do anything when you see a V shape. Okay, so if let's say from here next week, okay, what price is gonna do is, let's say it does this, okay, and then it starts to do this. Okay, which means that as it continued to develop, all right, it didn't break that low and it goes slow with a lot of overlap. Then you would form the first one here, the first scenario, which means that you would have a bias to look for buy. Okay, so this is the example that if you see a V shape, okay, don't do anything. Okay, so let me show you a crawl also. Okay, the crawl is actually okay, look at this. Impulse, a crawl up, which is your this third scenario. Okay, every time it has that, your bias is a reversal. Okay, even over here, you can see this impulse, and then this is a bigger crawl, right? So usually a crawl, you can draw like a diagonal pattern. When you see this, okay, there's a higher possibility you will see a reversal than a continuous upside. Okay, so that's why when you see a third scenario, your bias will always be to look for a reversal. Okay, which means short side to it. Okay, so giving you more example, let's say we go away from FX. Let's take a look at let's say other example, let's say gold or silver. Okay, if you take a look at silver, okay, the same concept and application can happen, right? You look at the most recent move, the bottom, the top, this move up very strong, okay? And then right now, what you're doing over here is still a correction forming because price element is smaller than this. The duration that is developing is already bigger than the previous one. So this is definitely forming a correction. Okay, so there will be a very high possibility that you would see more upside on silver than it going lower. Okay, so this is based on these three scenarios as a essence of Elliott wave, right? To start giving you something that is more applicable and very useful for you to define whether are you looking to buy, looking to sell. This is looking to sell. This is looking to buy. These two, no trade, all right, or basically wait. This one is a reversal bias, looking to buy. This one here, reversal, looking to sell. Okay, so based on just this simple impulse correction, combined with three scenarios, okay, you can actually start learning how to apply or start seeing waves movement on every chart. Okay, it doesn't matter which time frame you work at, which scale that you're looking at, because the general essence and concept of it apply. Okay, again, if you look at larger picture, this is up move. This whole portion here is a correction because the price element is smaller than this, right? The duration is longer than this. So this is definitely a correction. So the upside on silver will be, the bias will be to look for buy and not the short side. Okay, even if I decide to go lower time frame, okay, so for example, H1, right? So drop to even smaller time frame. The whole concept of the tree scenario and impulse and correction can be applied. Okay, look at this, down move, smaller correction, down move, smaller correction, down move, right? Of course, this smaller correction, it didn't give you more down move, right? So it's not 100%, which means that don't trade it based on all-in concept, right? So nothing is 100%, but it's high probability trading. Okay. Next, you see is up move. This one here is doing a correction. Okay. So again, you would expect more upside even on the 1 hour. Okay. Even if let's say today you decide to go smaller, 15-minute. Okay. That whole concept can be seen. Yeah. So if I show you this, this chart is a bit off. Let me go to Oenda. This one is looking better. Okay, so if you realize this, okay, 15-minute concept can apply. Impulse up, impulse down, do nothing. Followed by a crawl, look for reversal upside. Right now is doing a correction, look for the upside. Okay, so the same thing can apply on every time frame. Same thing, impulse, correction, the chance of it is going down. Impulse up, impulse down, don't do anything. Okay, V shape, again, don't do anything. V shape, this is an impulse followed by a crawl, reversal bias. Okay, so a lot of times you would see more success than failure, all right? But it's not 100%. So you do see sometimes it doesn't work. Impulse, crawl, third scenario, look for reversal, it happened. Okay, so again, this one here, V shape. You can see this? V shape, don't trade it, right? Impulse, crawl, reversal. This one is a simple impulse, correction, impulse, right? So V shape, don't trade, correction, can trade. Okay, so that's the concept behind this tree scenario. Okay, the part here that I want to share with you guys today is we don't have all the time in let's say in 1 hour today we can't cover too in-depth stuff. Okay, but what I decided to share with you and pick out is really the essence of wave, which means that even with this concept that you learned today in this webinar, without the labeling of 1, 2, 3, 4, 5 and things like that, it will already give you a very massive step towards understanding what Elliott wave is. Right, but of course, Elliott wave, there's a lot of more things into it. For example, like there are various patterns. For example, in technical pattern, you have double top, double bottom. In Elliott wave, you have like an expanding flat, a running flat, a 5-wave move, a ABC move. Those are patterns in Elliott wave. Okay, but those are not concepts. Today, what we cover in the webinar is really on concepts, right? Which is the building block of Elliott wave, and is very important. Okay, in Elliott wave, we use a lot of Fibonacci as well, which is basing on ratios, and things like that. So today, again, we won't be able to cover that. Okay, so I want to highlight all these things is because I want you to be aware that you can't learn Elliott wave in one night like that. Okay, but based on what we cover today, okay, based on just this concept of impulse correction and the tree scenario, you are very close in really understanding and applying Elliott wave. Okay, even without your Fibonacci, even without understanding those patterns, this tree scenarios is very powerful that you can start applying. Right? So hopefully you are clear with this, right? So what I've covered today to sum up in wave theory, okay, is take away these two things, right? Understand what is impulse, understand what is corrective. Really focus on looking at chart in terms of this 3 or 6 scenarios. Okay, if you really want to learn about Elliott wave, don't start with labeling. Okay, take away that conception that you need to, or take away the belief that you need to label a chart in order to start trading the Elliott wave. Okay, so the idea is even with these concepts that we covered, you can start trading Elliott wave. All right, so that is basically my sharing on wave. Again, before we go over to the Q&A section, I'll pass on the time to Joan, right, to share with you guys more good stuff.
Yeah, I always give the good stuff, right? So, yeah, so, well, to be honest, right? So this impulse and corrective move, when I heard it, listening to Karyong in one of his sharings, it already changed how I traded. I added it into what I knew on how I was trading before, and it really changed it. So you may be asking after listening, to the fundamentals and the wave, Elliott wave theory. So what's next, right? So you may be asking that. So what's next? Okay, so since Karyong is actually based here in Singapore, and it really, I mean, we've been working together for I think close to 3 years already, 2.5 years.
2.5.
So we've been traveling to Philippines as well, and he's only one person, and he cannot split his body like Naruto, like Kage Bunshin. Anyway, so we decided to actually do online courses, and as for the Filipinos, so I am the one actually who created a platform, and we will be delivering a course for all of you. So maybe you can show the page for them.
You know the website?
The WhatsApp I sent to your WhatsApp.
No, because it's not open.
Should be this one. T/ProTrader page. Yeah, so if you would go to this link, you will see here the registration page for if you want to continue and learn on how you can actually do what Karyong does. You can register into this page. So now cannot. So it's very simple. It's just pinoysmartfx.com/p/protraders dash page. So in there, you can check out what's inside. Basically, what's inside, you can find what he taught, the wave theory, and I think someone asked like, okay, when do we expect it to the correction to stop and go back to the impulse again? So it's being taught there as well, and then the fundamentals, the macro analysis is included. Some strategies on how to trade, the ABC pattern, the MW 866 pattern. So all this is included. So the platform that I created, because you're not going to be doing this live. So there's a slight difference if you actually attend live training. So the platform actually distributes the content not at one go. So this will be a 2-week training. So meaning you'll get some information on day 1, and then there'll be time to do some practice. And then on day 2, you will receive some more information. So you get to study and then practice again. And then so basically that's what happens. So in 2 weeks, you will receive everything, and then you have a lot of practice in your belt. So not only that, because Karyong also believes in the community, and he strongly believes that supporting the graduates after learning is very important. So they have a Facebook group, they have Slack. So we're now moving into Slack chat, so you will be supported there. So if you have more questions, I'll be glad to answer all of them. But what is important is if you go to Alpha Play's website, because it's also available there, you can, if you want to sign up to the Pro Trader program, it will cost you $697. So if you go there, alphaplay.com, you will get $697. But as a special prize for us Filipinos, he's smiling right now because he doesn't give discounts, by the way. That's why he's laughing. So if you sign up with the website that I gave, which is pinoysmartfx.com/p/pro trader dash page, and then you enroll, you can use a coupon. So there's a 20% discount for each and every one of you who attended today. So isn't that great? 20% discount. So it will only cost about $550 plus dollars. So that's a huge discount. I mean, if you really think you want to learn this, if you think this works, I do. If you can see the results that I post in Facebook, it does really work for me. And if you want to continue, this is, we're not pushing this, but if you really want to learn the proper way, we call it a very comprehensive program because it's really complete with fundamentals and stuff. You might want to really consider to enroll, and we hope to you can be part of our community as well. So I think that's all. If you have any more questions in terms of the program, Pro Trader program, you can ask it directly to me. Yeah. So by the way, the coupon is actually PAFTI 20%. So if you want to use the coupon to get the 20% discount, you just key in PAFTI 20%. All right. So now to answer the question, so we go into the questions, Karyong. Are you ready?
Yeah.
Okay. So there was this question from the part one, the fundamentals, from More Laughs, Less Stress. A very curious name. Anyway, his question is, what is your fundamental outlook on the dollar, US dollar?
Okay, before I answer, when I first saw that, I thought the comment was asking me more laugh so that there will be less stress.
maybe that's why his name is like that.
Okay, but to answer that, I think first thing I need to point out is many people get very confused about the US dollar. Okay, because I think all of you will be very aware that Fed has been increasing interest rates since last year, but the dollar has been falling. Okay, which means that it goes against that conventional aspect of when the central bank increase interest rate, prices of currency tends to go up, right? So the dollar does the exact opposite for the whole of 2017 and 2018 right now. It didn't really rally much also. Okay, so just want to share with you that the US dollar is a very unique currency because first is a global currency, which means that all your commodities, your stock market, many other assets, right, are traded in the US dollar. Okay, so the idea here is if you want to look at the US dollar, you cannot only look at the simple perspective of, let's say, looking at what the Fed is doing. Okay, because that is one force, which is the fundamental force of moving the dollar, but because of it being a global currency, right? There are many other forces that also affect the US dollar strength. Okay, and of course, one of the most important factor that we recently have is your Trump factor. So basically, Trump did mention that he wanted a weak dollar, and that really caused a lot of people starting to sell the dollar. Okay, even when the Fed is increasing interest rate. Okay, but if you also understand the backdrop of how the US economy is doing well, you will know that whole of last year or before last year, okay, employment rate in the US has been full employment, right? So the Fed has always been focusing on inflation, okay, but inflation in the US market has always been very low, okay? So it hasn't really increased in inflation pressure, and therefore traders, though the Fed are increasing interest rate, right? Traders are believing that this increase of interest rate is not really a healthy one, simply because your inflation data, the inflation economic performance in the US doesn't support that. Okay, so these are some of the other backdrop that you need to be aware of. If you really want to understand more about how US dollar is the global currency, what are some of the factors you need to take note of, you can actually Google this term called the dollar smile. Okay, so smile is basically SMILE. You'll be able to find out more information about why, more in-depth information, right, about why the dollar itself has a very unique characteristics, even when you take into account the fundamental aspect. Okay, which means that the dollar smile effect is basically, okay, if I draw it out, okay, let me draw the smile effect so that you understand this whole concept. Okay, so what I mean by the dollar smile concept, right? If you Google it, you actually would see this illustration, right? So it's like a smiley face. Okay, so the idea is this. Okay, this is representative of. Okay, so this is the axis, huh? Okay, this would be your strength of your US dollar. This would be your economic performance, right? So it's an E, huh? So the idea between this dollar smile here is this: if the economy, global economy, is performing very bad, okay, your dollar will tend to strengthen. If your economy is performing very strongly, your dollar will also strengthen. But if your economy is hovering in the middle, okay, which means that the global economy is going nowhere, is somewhere in a very stable growth, not much of inflation, not much of recession, your dollar tends to be very weak. Okay, so this is the concept of dollar smile. Just to share with you very briefly in this Q&A. But if you really want to understand more, just do a Google. You actually get more information. Right. So my outlook on US dollar in summary, okay, is this: 2018, selling the dollar is not good, which means that the potential of downside is pretty limited. Okay, but buying the dollar is not yet the time to do it. Okay, which means that, in short, layman term, don't sell, look to buy, but don't buy yet. So the idea is wait. Yeah, but the idea is wait for a buy catalyst. All right, the term catalyst here, I mean that you want more information to show you sign that, okay, it's ready for you to buy the dollar, right? But just don't sell it, because based on what I've seen in research into, technical wise, fundamental wise, macro wise, it's not a good idea to sell the dollar this year.
Yeah. So imagine every week when we have our traders meet up, we always ask Karyong, so is it time to buy? Is it time to buy? But yeah, well, it's just amazing how much time Karyong puts into all of this research and analyzing the charts. I hope we answered that question. So can we move to the next one?
Yeah.
Okay. Actually, Roland Amaranto asked a very good question, but I wanna delay that for a bit.
Okay.
So we can ask the others. So Kido Salamera asked, is there an instance that the press release or the news event that is released is released to mislead the market? Mislead, like to confuse the market.
Okay, you mean intentionally,
Yeah,
right?
I think intentionally.
Okay, if you mean intentionally to mislead the market, likely not. Okay, the reason is very simple, because these data are released from a government statutory board. It can't fake. So the idea is they can't come up with any number. All right. When I'm saying this, I'm referring to your more developed countries. Right. We all know that certain countries can release fake data. Countries that is very huge, starting with a C. You probably know which country it is. They can release fake data, right? But when we are talking about major developed countries, they can't fake the data, right? And these data are all factual recorded data, so it's really economic data. They can't release with the intention to mislead the market.
Yeah.
Okay, but there will be fake spike here and there, simply because of how different traders analyze and interpret the market very differently based on one simple news. All right. So that's the part where if you want to avoid being fake out in the market, all right, the idea here is you want to have more factors into deciding whether you want to buy or sell before the news is being released, right? So you might need to incorporate maybe more technical aspect of looking into the chart instead of just blindly trading, based on a news release.
Yeah. Cool. All right. So next question, Dina Policarpio asks. So how do we know what the country will focus on if say for example on the same time, right? The news release will be opposite. So one is negative and one is positive. Like for example, labor and inflation data. So how does that affect the fundamental analysis?
Okay, most of the time, when it's a conflicting data, all right, generally the price will move. So this is what we describe as non-event, which means that when let's say 8:30, all right. So this is very common. In NFP Friday, okay. A lot of times people only refer to NFP being released on that day, but actually if you look into it, on Friday 8:30, our time. All right. So it's not only the NFP data being released, you have your unemployment rate in the US. At the same time, the average hourly earning. All right. So that is where you get inflationary data being released at the same time, employment data being released. Okay. If it's a mix and at that point of time, the central banks are still focusing on both data. Okay, likelihood what you see is a non-event, which means price will unlikely move much. All right, so price will still move, but maybe within a range of 25 to 30 pips. Right, it won't move a lot because of conflicting data. Right, but sometimes you would see a huge spike up or a huge spike down, and then it reverses very strongly. Okay, so those usually happen because the back end of why this might happen is because when there's a press conference, all right, so data release, and then after that you follow it with a press conference. So the chairman or the president will actually talk about their outlook. Okay? So when they talk about the outlook, basically the price will keep reacting to whatever they say. Okay? So the part here is you cannot only base your fundamental analysis on one economic release, right? So the idea is always look at it overall. That's why we always also mention and remind traders that you cannot trade purely based on FA or fundamental analysis because there's no entry element for you. There's no time element for you. So fundamental is very good in giving you the understanding and giving you the price or I would say the alignment of where you want to trade. But it's not a good analysis factor to give you where you want to enter.
All right, cool.
Okay.
Questions from your side?
Okay, for wave, I'll answer is second part. All right. So there's one question that talk about workflow. Okay. Benjo asks, can I share the workflow with fundamental analysis? Do I consolidate everything in a spreadsheet? At the start, very good question, because at the start, yes, I do, which means that it's more like a journal, right? So the idea is okay, let me see if I can pull out some example for you guys, so it becomes more concrete in our sharing. Okay, there's many back-end work, which means that effort that's being put in that you might not see it right now, because we don't present the hard work. People don't like to see the hard work. Okay. But
and they don't want to even do it.
Yeah, they don't want to do it. So we will I'll show you some of the back end tough work that usually we do. Okay. So this is one example, right? So I stopped doing this already because the idea is what I have transited into is more of reading and following through regularly and consistently with the central bank's minutes, with how the economic data are being released. You slowly will have a good gauge as to how the market is doing, right? But as a start, to get yourself familiarized with the process, you do need some things to help you in terms of noting down, whether the economy is performing, what are the central banks doing, and things like that. Right. So I actually do all this in the past, right? So this report, if I'm not wrong, is actually in somewhere early 2017, week 9 2017, right? So the idea here is I do all this, like, look at the week event, jot down how the event happened. Is it improving in the economy? Is it not improving in the economy? And then I also do a lot of looking into the central bank meeting minutes. What are they doing? Okay, including some of the COT analysis. So a lot of all these things I do it in the past to jot down, right? So those are practice effort, and from that eventually you get a very good good understanding, you can get a very good feel of what you need to take note of in the market. And then eventually you don't need to do all this physically, right? But it's all in your brain.
Yeah, so basically you get used to it so that it becomes kind of like automatic.
Yeah, but you need to follow through the market, or else you probably, like imagine 1 month of not trading. Then you need to come back to the market and then at least find out what you missed out in the 1 month. But if you do it consistently, you can follow through all the while.
Okay.
Yeah.
I have one more question, which is perfect timing because Lan just messaged me again. So his question is very interesting. So he asked, do you consider intermarket analysis like fixed income securities and equities in your analysis? If yes, how? Yeah, he wants to know how.
Okay, I think it's a very good question because if you are looking into financial market, right, not only currency, as if you are a trader or you're an investor, you cannot only look at one asset, which means that like currency is one asset, fixed income is one asset, equities is one asset. This whole category of intermarket analysis is called macro analysis.
Yeah, I was just mentioning it, right? Macro analysis.
So yes, the straightforward answer is yes, you need to consider because each asset will have a direct impact on other asset. And looking at the macro analysis of the global financial scene, right, gives you a very good picture of what is happening globally, right? So the question here is the most recent drop in S&P and Dow Jones, right? Many traders think that, is recession coming and things like that. That is where if you understand the macro perspective of financial market, right, you would have certain information and indicators to tell you, is it into a recession or is it not in a recession? Okay, so the part here is based on our macro understanding. Right, 2018 will unlikely see a recession. Right, so if I repeat, we won't see a recession in 2018, unlikely.
Yeah, that's good news for employees, man.
but doesn't mean that you straight away buy, right? So you still need certain plan to go and trade plan to time your entry. So the answer to that question is really about yes, you need and you cannot, no matter if you're just trading currency or you're trading equities, you need to know a bit of macro perspective. Yeah.
Cool. All right. So and just to add to that, right?
Yeah.
So I did mention in the Pro Trader program itself, it's one of the modules. So it's being discussed very thoroughly, and you can get to understand all of this in the Pro Trader program. Okay. Do you have any more fundamental questions, or we move to the wave?
Not on my side. All wave, yeah. Wave.
Okay.
We can move to a wave.
Yeah, sure. You start first.
Okay. Joe Rep asks, what is the lowest time frame you can apply Elliott wave theory? I would say that technical analysis, basically any time frame you can apply it. The only thing you need to know is if you go lower time frame, the frequency of how price move in up and down increases dramatically, right? So for example, 1 hour, if you are in a 1 hour chart, every hour you get one candle. But if you are in a 1 minute chart in 1 hour, okay, I can't do the maths, but you're going to calculate. There's a lot of candles,
Yeah.
right? So the idea is if you go lower time frame, the concept applies, but because of the frequency of how price move up and down increases, you get more trade setups, which means that in 1 hour, you probably get one trade on a single day. In a 1 minute, you probably get maybe 20 trades in a single day. Right. So the idea here is if you go lower time frame, you need to be very aware that you will get more trades, and therefore more trades doesn't necessarily mean more winnings.
Yeah.
It also means more losses. Right. So the idea here is many traders, when they go lower time frame, they are not aware of this. They are not mentally prepared of this. When they trade it affects their psychology. Yeah. But if you can trade it consistently, right, your win rate percentage would still be there, which means that 60%, if 60% is your trading plan strategy, you go and apply this plan on 1 minute, you probably get around 60% also. It's just that this 60% is not like the next 10 trades you take, you win 6, you lose 4. Because you can lose, like, let's say the next 10 trades, you lose all 10. But the subsequent 20 trades, you win all 20 trades. Right? So that is something that many traders are not aware of.
And not prepared to.
Yeah, and not prepared to, right? So
Yeah.
the idea here is the best time frame for most of the retail traders, including myself, is to stick to somewhere between 30 minutes to 1 hour. That would be the best time frame for all of us to trade.
Cool.
Yeah.
All right. Okay, let me ask one first. This is from Evelyn Ling. So yeah, I think I say, how do you know where the corrective move has stopped and start to impulse move?
Okay, so that's a very valid question, because if you're not able to answer that question, you can't trade, right? Because based on today's covering or concept is building the directional bias, right? But
Yeah.
that question itself comes to a strategy, which means that to answer that question, you need to have a trading strategy. So your strategy is where okay, so for us, what we do is we use this thing called wave expectation and ratio expectation. All right. So this part here, we didn't cover today simply because of time limitation. We won't be able to cover everything in such short period of time. Right. So generally, to answer that question is you will need a strategy that is working to a certain percentage to capture where is likely the correction gonna end.
Cool.
Yeah.
Yeah, but maybe I can add my experience. So when I first learned about the impulse and corrective move, I was using a few MA lines, moving averages, and I can already use it just by knowing that. Okay, next question. Yeah, we extend. I hope you don't mind. We have extended a bit, but we'll just finish the questions.
Yeah. Okay.
From Vito.
From Vito. Okay, so Vito question is this. All right. So he typed and asked. So generally, you are focusing on forecasting as well as looking for major inflection points that drives the price towards its intended direction based on economic data. Then identify the overall bias if it leans towards more, whether it's inflation, interest rate, job data. Right. So his question is, how would you apply that in the perspective of Elliott wave if it shows contradiction? Oh, okay. If it shows contradiction to your overall bias view. Okay. He added on, more so since Elliott wave seems to be dependent on those wave. Do you consider this type of move misdirection at times? Okay. Okay. Many of you might not understand his question, but let me summarize to a simpler way. And Vito, if you're still in the room, just let me know if I understood your question properly. Okay, so the idea here is his question generally falls in this category of, if technical analysis based on Elliott wave tells me buy, fundamental tells me sell, what would I do? In short, hope that is what your question is.
And I think based on the weight expectation.
Okay, so he said yes. Okay, so very good. Okay, so let me give you a very good example. Okay, so I'll bring one example. I'll bring one example on the trade ideas that we are going to share with you, and if you download, you get it. Okay, so I'm going to share this example. Okay, first is technical. All right, so this is dollar index, which means that on a technical based on Elliott wave concept, all right, I'm having a bullish bias, all right, which means that I'm no longer interested in shorting the dollar based on Elliott wave, okay, and I'm looking to target. That means if I buy, my target will be somewhere around this 96, all right. So you see some ratios on this chart, you see some label, all right. So those are Elliott wave, more advanced understanding after applying the impulse and correction aspect. Okay, so for example, technical, I'm bullish. Okay, but we all know that fundamentally right now, Fed is increasing interest rate. Okay, but since Fed started increasing interest rate, this whole dollar hasn't been rising. Okay, and the next thing you need to take note of is on top of just the Fed saying that they got increased 3 times. All right, most of the time when such piece of information has been released into the market, traders have probably already taken that information in, which means that if price doesn't move when the information was released, they basically didn't, they feel that the market has priced in, so they don't buy anymore. Okay, so what we need right now, which means that fundamental right now and technical right now don't align, because the fundamental of US right now is they have been consistently increasing rates since last year. Okay, but the economic performance of inflation data hasn't really picked up yet. Right, so the idea now is we want the fundamental to tilt towards a buy side, and technical we already have an alignment, which means technical we are already looking for buy. What we are waiting for right now is for the dollar to show a fundamental strength. Then we would have a very good trade to look for the buy side. Okay, so if I bring you to, let's say, another example on another currency. Okay, let's say Euro franc. Okay, so Euro franc, if you base on this, we have a bias on shorting it, right? The idea then now is, does Euro has a very weak fundamental to push this pair down, all right? Or because if you are looking at Euro franc, you also want to look into the Swiss franc currency. Does Swiss franc has a very strong fundamental to push this pair of Euro franc lower? Okay, so if you look at Euro, the economy fundamentally is already not very well, right? There might be some improvement and things like that, but generally Eurozone is in its own trouble as well, because if you go and look into the Euro countries, many of them are in debt. Okay, and the closest that is probably gonna fall, something like Greece, will probably be your France and Italy. Right, so all these things are where you need to have a fundamental backdrop, right, to support a technical, because technical alone won't move the price as strongly as a fundamental force, right? So that's the part where I want to also highlight that fundamental give you the understanding to support why price will move. Technical give you the understanding of where to get in, where to get out. Yeah. So if you combine these two elements in trading, you trade with a very high conviction.
Yep, yeah. I do agree with that, and I can see that happening. Okay, last two questions. So one is from Ernest, which can be answered very quickly. Ernest Big asked, in identifying the wave, is it recommended to use daily time frame?
Not necessarily, all right. But the idea here is today we didn't touch on this concept, but we need to look at multi-time frame, which means that even if, let's say, I trade on H1, all right, I need to look at 4-hour and daily time frame to really understand the bigger picture of what is happening in the currency pair. Because if you look at H1 chart, the information you can see is that much only. So you need to really go to like 4-hour and daily, right? So to answer that question, is it recommended to use daily? There's no best time, but I would say that if you are starting off first, the higher the time frame is, the easier it is, because the frequency of price going up and down is less, which means that you have more time to do your prep work.
Yeah. Yes. And you can hold the trades longer as well, so you don't have to really worry about it. And then the last question is from an engineer, Raniel Taripe. So he said, sir, where is the best site to see? I think this one is to see currency correlation.
Okay. For currency, okay. Before I share with you that site, the first thing, since you talk about currency correlation, I just want to point out, I think I saw this just today, right? Many traders actually think that currency correlation equals causation. If you don't understand what it means in layman term is, because, okay, give you an example. Okay, because he is my brother, and if he is bad, therefore I am bad. That is called correlation and concluding that there's a causation, right? But in trading, you want to be aware that correlation is a phenomenon, which means that so happen, it tends to happen. It's not that if something happened, therefore the other thing happened, right? So many traders take correlation and make trading decision based on correlation. That will cause you quite a bit of challenge if you want to do that. And my advice is don't use correlation to make a trading decision, right? But use correlation for risk management. That one I think we have covered it quite extensively as well in the class. Yeah. So the idea is use correlation to do risk management, but not use correlation to make trading decision. So if you want to do correlation, there is this website called
is it heat map? Is that the one?
No, it's called Chart Alert. Have you heard of this before?
No.
Okay, let me find out a little chart artist. I don't think that's right. Okay, never mind. Okay, Forex Factory have the other one is My FX Book.
And one.
Yeah, if you're using Owenda, I'm not sure if they have it. I think have it. Okay, but My FX Book, I know have it. The other one is something along called Chart Alert or Chart Artist or something like that. Okay, I never really focus on all this, but I remember I see it before, right? So if you go to myfxbook.com under market, under correlation, okay, if you click into it, you can see a table where they share with you what are the current, okay, Vito also shares some of the links, okay. So you can see that there's this market correlation table, right? So you can,
I cannot say.
You can actually see like odd cat, and odd cat is of course 100% correlated. Then between let's say Euro dollar and Aussie Canadian, they have a positive 66% correlation, right? So this website, My FX Book, do show you that. So again, highlight that correlation is a phenomenon in the market, but don't make a trading decision because of correlation, because because of it being a phenomenon, it can not correlated at times. That's strength. That's all. Yeah. So Vito also shared. So if you are in this, you can actually click onto the link and then go over it as well. Yeah, cool.
All right. So I guess we overshot about 23 minutes. I hope everyone is okay with that. And I hope everyone learned a lot. And if you do want to continue to learn about wave theory, Elliott wave, just enroll. It's worth it, definitely. I can attest to that. I'm a student, and it doesn't end there actually. Just yesterday we had I attended my first tutorial, and Karyong taught about how to count waves, which is really helpful now. So yeah, so Alex says, thank you for sharing your knowledge and more time to answer our questions, KY. I hope you will not get tired in educating more traders. Miko says, thank you. All right. Thank you, guys. Thanks, guys.
Thanks, guys.
So yeah, with that, Karyong, any last words?
No, have a good weekend.
have a good weekend. And yeah, we do hope we can do this next time as well again.
Yep.
Right? All right, cool. Thanks, everyone.
Okay, bye-bye. What? I haven't end my YouTube.